Welcome to The Explainer. Today, we are breaking down what is, without a doubt, the single most important skill that separates winning traders from, well, everyone else: advanced risk management. It's not about finding that perfect magical entry, it's about protecting your capital so you can stay in the game long enough to actually win.
You know, this quote isn't just some fancy line to put on a slide. It is the absolute foundation of professional trading. The real outcome of your trade, it's decided long before you ever click buy or sell. It's won or lost in the prep work and the risk plan you build before a single dollar is ever on the line.
So here's our game plan. We're going to build this out in 4 parts. First, we'll tackle the crucial mindset shift. Then, we'll get into the exact pre-trade blueprint the pros use. After that, we'll cover how they manage trades in real time. And we'll wrap up with the rules that protect both their money and their sanity for the long haul.
Okay, let's dive into the most important part first, your mindset. Seriously, before any strategy, before any indicator, you have to fundamentally change how you look at the market. This isn't a casino slot machine. It's your business, and you're the CEO.
Here's the thing, most traders fail because they walk in with the gambler's mindset. They're fueled by the hope of a giant win and the fear of missing out. Every decision is an emotional roller coaster. Professionals, though, they operate like business owners. They are obsessed with their process. They are ruthless about managing losses, and every single decision is systematic. Their number one goal isn't to get rich tomorrow, it's to survive to trade next year.
I love this analogy because it captures the whole idea perfectly. Think of your trading career like a long voyage across a stormy ocean. You know for a fact you're going to hit storms. Drawdowns are just part of the journey. The gambler hops in a fast, fragile speedboat. It's exciting, sure, but it gets smashed to pieces by the first big wave. The professional? They build a slow, durable ship. It's a robust process, designed from the ground up to withstand any storm. You see, the slow way is the fastest way to get there, because it's the only way that actually reaches the destination.
All right, with that pro mindset locked in, let's actually build the blueprint. This is your pre-flight checklist. These are the non-negotiable rules you follow before every single trade. This is how you take emotion completely out of the equation and operate with pure ice-cold discipline.
Think of this rule as your body armor. The 1% rule is so simple, but it is the one thing that will keep you alive in this game. It means you can take a brutal string of losses, 10, maybe even 20 in a row, and you'll still have capital to fight another day. Now sure, some top-tier pros might stretch that to 1.5% for a perfect setup, but for 99% of us, 1% is the unbreakable rule for longevity.
So how do we make that rule a reality? It's not guessing, it's just a simple 3-step calculation. Step 1, you figure out your capital risk. On a $10,000 account, 1% is $100. Easy. Step 2, you look at your chart, you do your analysis, and you decide your stop loss needs to be, say, 50 points away. A point or pip is just how we measure price moves. Finally, step 3, you just divide your dollar risk by your stop risk. $100 divided by 50 points gives you a position size of exactly $2 per point. No emotion, no guesswork, just math. Now this is a huge one. Professionals don't just pick an arbitrary number for their stops, like, oh, I'll use 20 pips on every trade. That's crazy. They adapt to the market's current personality, its volatility. The main tool for this is the average true range, or ATR. It's an indicator that just tells you how much an asset is moving on average. So if gold's daily ATR is $40, putting a $10 stop on it is just asking to get shaken out by normal market noise. Instead, you base your stop on a multiple of that ATR, maybe 1.5 times, and now you're giving the trade room to breathe and actually work. And right here, this is the brittle, unforgiving math that makes all of this so critical. Just look at these numbers. A 10% loss? Okay, you need an 11% gain to get back to where you started. That's manageable. But a 50% loss requires a 100% gain. You have to double your entire remaining account just to break even. This is what's called the asymmetry of losses. It proves that your number one job isn't to make money, it's to avoid digging a deep hole.
So, you've planned everything. You've taken the entry. The job isn't over, not even close. In fact, this is where the real work begins. Let's look at how the pros dynamically manage a position to cut risk and lock in profits while the trade is live.
You gotta remember, pros rarely think in all or nothing terms. They use flexible management. Scaling in is adding to a winning position, which is a more advanced technique, but scaling out, that is a risk management superpower. It just means you take some of your profits off the table at your first target, immediately banking some cash and lowering your risk. Here's a super powerful, practical example. Let's say you're long 2 lots of Bitcoin. The price shoots up and smacks your first profit target. You immediately sell one of those lots, locking in that win. Then, and this is the key, you move the stop loss on your last lot all the way up to your original entry price. And boom, just like that, you've engineered what we call a risk-free trade. The absolute worst thing that can happen now is you break even on the rest of the position. The best case, you catch a monster trend.
A trailing stop is basically your automated profit protector. It works like a ratchet. It clicks upwards as the market moves in your favor, locking in your gains, but it doesn't move back down. So instead of guessing where a trend might end, a trailing stop just lets you ride it for all it's worth while systematically protecting your profits the whole way up. When the trend finally does turn, you get stopped out, but you've captured a way bigger piece of the move than you ever could have with a fixed target.
All right, let's zoom out one last time. We've gone from the big picture mindset to individual trade tactics. Now let's talk about the rules that govern your entire career. These are the safeguards that protect not just your account balance, but your single most valuable asset, your psychological capital. These are your personal circuit breakers. They are hard, non-negotiable rules you set up to save you from yourself. Say you have a rule. If you lose 2% in one day, you shut it down. Platform closed, you're done for the day, go for a walk. Or maybe after 3 losses in a row, you take a mandatory break to review what's going on. This isn't weakness, my friends. It's professional discipline. It stops revenge trading dead in its tracks, and it prevents that emotional downward spiral that blows up accounts.
Okay, now here's the hidden trap that blows up countless accounts: correlation risk. You might think you're being smart and diversified because you're long the euro against the dollar and you're long the British pound against the dollar. But really, both of those trades are just a bet against the US dollar. If the dollar suddenly rips higher, you lose on both positions at the exact same time. We see this with gold and Bitcoin too. You haven't spread your risk at all, you've just secretly multiplied your exposure to one single idea.
This quote really captures the soul of professional trading, doesn't it? Every single day, the market is going to tempt you with what you want right now. The thrill of a bigger position, the urge to immediately make back a loss. Discipline is just the raw ability to say no to that impulse over and over and over again in favor of what you want most, which is a long, sustainable, and profitable career.
So here's the real takeaway. To join that small percentage of traders who actually make it long-term, you have to shift your entire focus. Stop being a profit hunter. Become an obsessive risk manager first and a trader second. I promise you, the profits will follow that. So let us know down in the comments which of these techniques has made the biggest difference for you, or which one are you going to implement first.